So, hi everybody, and welcome to our show, which we call Market Makers. Today, our guest is Neeraj Gambhir, who's head of global markets at Axis Bank, and has had a storied career. Having spent a lot of time in markets, and particularly having made his cut his teeth, so to say, in fixed income markets, and then evolved to head of markets. Also, Neeraj is vice chairman of FIMDA, involved with a lot of market initiatives, and has been in the past, of course, in several committees and all, in various roles to try and see what we can do for markets. So obviously, he was the best choice at the start of these shows. This is only the third show I'm doing. The first two were Neeraj, Nilesh, and Prasanna, and which brings me to another point which not too many people may know, but all three of you are started at ICICI. So the question was, is it something they fed you in the cafeteria or the water at ICICI?
No, it's something that they, the way, they kind of very early upbringing, I would say, in an organization that you get. I would say it's part of ICICI DNA. And for all of us, particularly for me, when we were starting our career in the early 90s, the markets were just opening up. They were coming of age. It was the early days of India's liberalization story. And ICICI was perhaps the best place to do it all, to learn it all. And I think the unique thing about the organization was the amount of independence and freedom and willingness to experiment that was there in that organization, right? So which kind of helped us, in some senses, navigate the early days of the markets, early days of the changes that were being brought into the economy with multiple ways and multiple things. Nilesh and I have been contemporaries at ICICI. Of course, I've worked with him for almost a decade, and so has been Prasanna. So I think it's, I would say, old friends again.
Absolutely, and for me, there wasn't a very difficult choice. Who were the first few guys to
Yeah,
to interview?
yeah,
So
we are the furnitures. We are now the furnitures of this market.
if you guys are the furniture, I don't know what I am. I'm the wood. So market makers. I think, as I said, more possibly it should have been called market movers. You guys are the current market movers, and who better to interview you guys than an ex market mover? If I may say
Yeah,
so
I was about to say
immodestly.
that you've been market mover yourself, right? So now watching it from the sidelines.
Oh yeah, and I really enjoying talking to you guys and interacting with you. So let's, with that kind of brief introduction, let's jump into the topic at hand. This is intended to be for the consumption of active market participants, like fund managers, asset managers, treasury, dealing room, staff, and so on. So I thought we keep it snappy and focused on three or four market topics which possibly they'll find of interest and which of course affect all of us. The first is interest rates, and it is quite interesting because, and current, I think, because we've just had never seen before kind of very rapid rate cuts, 100 basis points upfronted, front loaded, whatever you may call it, and kind of shook up the market a bit. We saw the curve steepen. We saw a little bit of a sell off immediately. The governor had to come and clarify that maybe it's not the end of the story and so on. But what it means to the market is what I wanted to ask you. So, does it mean what we see, that indeed more or less we are at the end of the interest rate easing cycle, given that inflation is below 4 or close to 4 at RBI's bottom comfort level? You have a 1.2 or 3, whatever is real interest rate target, and then you're at 5.5. So do you think that's the story, or do you have another view?
So this is my maybe fifth or sixth interest rate cycle, right? Ever since the start of my career in the last almost 30 years. And every rate cutting and rate hiking cycle, I think I have now come to the conclusion that market very reluctantly gets into the mode of either rate cutting or rate hiking, initially believing that this is a very shallow cycle, maybe one cut, maybe two cuts, right? And then the reality unfolds. Nobody really knows how deep the cutting cycle is going to be or rate hiking cycle is going to be. Um, and I think in general, we underestimate the size of the cuts or size of the hikes that are going to come our way, right? So um, I think this cycle was no different in that sense. We all started by believing that really there is no story for RBI to cut rates. If you believe, if you go back, say, about 6 odd months, right? And then we started by saying, you know what, maybe 50 basis points. So this is a very shallow rate cutting cycle, right? Um, and market got itself into from 50 basis points to 100 basis points now demanding more. So that's the nature of the beast, right? So as the cycle unfolds, people want more, not realizing that what has already been done is much more than what was expected at the start of the cycle. So Reserve Bank has ended up doing a 100 basis point cut. We all started with the belief that 50 is the max that will happen, right? And yet bond market is not happy. So that's the nature of the beast. Um, I don't think we fully understand as yet as to how deep this cycle can be. And the reason I say this is because we're dealing with a huge amount of uncertainties on various counts, right? First and foremost, inflation has actually surprised us on the downside, right? We're currently below 3% on CPI headline. Even on core, if you strip away the impact of gold, the core inflation is extremely benign, right? And I don't remember any time in the past, say 30 years, when we've seen such structural change in inflation to say that core is also below 3%, effectively, headline is below 3%. We believe inflation will normalize to 4.5% in the next financial year, but who knows how things will play out, right? So I wouldn't as yet completely write it off to say that this is the end of the story because um, the story has already played out more than it was expected. Can it play out some more? Possible. So it's in the realm of possibility for me. Uh,
And I think, sorry,
sorry,
go on.
go ahead. No, go
No,
ahead. You first.
I think also one takeaway possibly is that the steepness of the curve provides opportunities at the very long. I
That's
would
right.
think,
That's right.
over 7% for 30 years, etc. I think does provide opportunities, and I do think, Neeraj, somehow our longer end of the curve has never found the appetite that it should. And one example, or I would like your comment on that, is even asset managers. Typically very few asset managers, mutual funds, have really long dated stocks in their portfolio. And apart from government bonds, there are hardly any long dated issuers, right? So you agree with that, and do you think
No, I think it's again fixed income markets are a little different. Unlike in equity markets, where a fund manager has a very wide choice of figuring out what kind of typically you will see in equities people have ability to mix and match between strategies. Even if you're running a diversified large cap fund, you still would mix between growth and let's say value, right?
yeah,
In India, not just in India, but I think generally globally, fixed income um, mandates for fund managers are very duration specific, right? So either you have liquid funds, or you have medium duration funds, or you have long duration funds. And long duration funds typically end up being with pension funds and insurance companies, because that's how the long duration liabilities actually play out in the system, right? It's not with banks, it's not with mutual funds, it's really with pension funds and insurance companies. And as that piece of asset base AUMs have actually grown in India, I would say that the demand for longer end of the curve has actually grown concomitantly. So to me, the biggest driver of longer end of duration demand comes from pension funds, insurance companies, etc. NPS, for example, is now a big story, right?
yes,
I'm the chairperson of Axis Bank's pension fund company, and I see the kind of growth that we are seeing. It's amazing, right?
yeah,
And there, if you see NPS fund managers, they run a duration of 10 years in their fixed income portfolios. So truly, duration sits with these guys, and as these guys increase, we have seen better demand, I would say, relatively speaking, for longer end of the curve, both in corporate bonds as well as government bonds. But I think it's a phenomenon that will play out over the next 10, 15 years. I think there is still more to go. I think we're at a very initial phase of growth of that segment, which will drive duration demand in this country.
And you mentioned NPS, and I'm an early convert, amongst the
Yeah.
first early guys to invest. And I can tell you that if you just track the returns, they've been fabulous. So unfortunately, I think it's whether it's education or it's lack of the same, or just resistance to anything which seems so simple. इसमें charge नहीं है, it's like hardly costs anything. Government का है, so I think is it that or what? But anyway, if you have a comment, you tell me. But otherwise, you move.
No, I think NPS is being discovered. I think in retail investors, it gives a fabulous choice in terms of the cost of fund management is so low, 9 basis points. I think you can't find it elsewhere in the system. So it's really a very cost-effective way of managing your money for the long term, and it has a lot of optionality built into it in terms of so I think obviously a product like this takes time for people to understand and invest. And in general, I think look, my fundamental thesis in life is that we are still about a $3,000 per capita income economy, right? We've come a long way from
Yeah,
$1,500 to $3,000, and within that $1,500 per capita income change, we've seen dramatic changes in our system, right? Look at the size of our mutual fund industry today. Look at the size of our pension industry today. Look at the size of our insurance company today. All this has happened in a span of $1,500 per capita income change.
true.
Imagine this $3,000 becoming $15,000, which is where China is today,
Right.
and see the size of financial services industry, whether it is banking system, whether it is insurance companies, whether it's mutual funds, whether it's pension funds that you will have to deal with. To me, the journey is just started. I think it's still a lot of upside in these areas that is still there.
No, I think that's a great real life example. So very useful. People don't realize that. So now let's come to a fun question. If you were RBI governor, would you have front loaded everything, and then or you would have kept something for the market, or just that maybe if you're RBI governor, you would have known much more.
Well, first of all, I'm not. So it's hard to think like one because I don't know what the pulls and pressures of the job are and of that seat are. But I think as a monetary policy authority, uh, we need to understand that they have different objectives, right? As a bond trader, my objective is to see bond yields go down and make money in the process. But I think from a policymaker's perspective, I think rate cutting cycle has to perform certain things. It has to deliver certain outcomes. And the biggest outcome that it has to deliver is growth, right? So how do you kickstart growth? How do you make sure that there is a big impact of these rate cuts it results in, right? So if you see it from that perspective, I can very well understand why Reserve Bank decided to do what they did, which is basically, and particularly now that the structure of the banking system is such that EBLR linkage means that within a quarter, these rate cuts get delivered into real EMI savings for the borrowers, right? Um, so effectively, if you're trying to do that, if you're trying to create that sense of incremental money in the hands of the borrowers, then that's the best way to do it, right? Obviously, that may not be most optimal for the bond market, but bond market is a very small piece, right? You impact lives of millions of and billions of people if you do it in a different way. So I think that's what they've tried to optimize.
And given
Uh,
that inflation data till far ahead looks very easy.
yeah, I think at the end of the day, for every monetary authority, and not just for Reserve Bank, and whether they are explicitly inflation targeting or not, I think they become growth focused only when inflation affords them to,
Very
right?
true. Well
Uh,
mentioned. Yeah.
and in Indian context, in our context, I think that scenario has evolved over the last 12 months when inflation has turned in a particular way to allow them to now start thinking about growth, right? And to me, it's like this. I mean, inflation is the red line. I mean, you don't cross the red line. But if the red line is such that it gives you a large boundary to play within, then you will go to the extent that you can, right? Which is why I feel that the story is not yet fully written out on this path of rate cutting cycle, because at the end of the day, uh, at $3,000 per capita, 3,000 also not there. I think it's about $2,600 per capita income versus 14,000, 15,000 per capita income. We have 5x growth to jump, right? Even if I just compare with China. So every government, every policy maker will try to maximize the growth outcomes, provided inflation does not become a problem, provided current account doesn't become a problem, provided external sector does not become a problem, right? And today we are in that spot where none of this is a problem. So
Right.
why not go full hog chasing growth? I think that's the argument that I would put.
No, no, absolutely well. I think we've covered the interest rate fixed income part reasonably well.
Mm.
Let's get on to, you mentioned current account. Get on to FX. And, we've seen dollar INR went all the way up to 88, then down to 83, now again 86 plus and hovering around that. So, pretty much kind of mimicking a bit. We had significant FPI outflows at the start, and then we've seen a recent fairly significant FPI inflow. So, do you think the story is entirely FPI related? Any other factors to look for?
No, I think there is a regime change. And that regime change is quite perceptible since the last, I think, 6 to 9 months. Um, if you recall, for a long period of time, Reserve Bank held rupee in a very, very tight range, right? And all of us who were been in the markets were basically complaining that this is breeding some kind of complacency in the system. Such a low volatility, I think it's kind of creating certain incentives of not to hedge in case the volatility. So first thing to me is that there is a regime change. There is now higher appetite for vol in the currency, and there is also a willingness to allow the currency to play on both sides, to move on both sides depending upon the flows and depending upon the sentiment and the broader dollar direction. And weakness in rupee has kind of mimicked, the strength that we've seen in dollar. Not, of course, the last phase, but in general, it has been sort of
Dollar
tracking
index.
dollar strength, dollar weakness, particularly with emerging markets, particularly looking at what's happening in China, etc. Right? This last phase is a bit different in the sense that while dollar has weakened, Chinese yuan has strengthened, but rupee has still weakened. So you could say that this is, in some senses, reflective of our own capital flow story for the time being, at least in this quarter. And usually Q1 for rupee tends to be a weak quarter because you have a lot of outflows, but not so many inflows because exports are back-ended. On capital flows, I think look, FPI flows are going to be very unpredictable given the kind of world we are in, right? It's geopolitically now extremely sensitive. I mean, I give a simple example. If you are a manufacturer today, if you're to set up a new factory and you're looking at setting up this factory with world sort of distribution, right, including in US, where would you set it today? Very hard to figure out, right? You would not set it up anywhere today, given you don't know what's going to happen to tariffs, you don't know what's. So, a lot of these capital intensive decisions that people have to take, I think, are in abeyance. It is reflecting in our FDI, it is reflecting in global capital allocation, global capital spend, right? Um, in India's case, as Governor pointed out, and this is what we've been saying, that while it might look like the net FDI is negative or not so much, but the gross FDI is still $80 billion. We are seeing a lot of repatriation flows. We are seeing a lot of private equity firms taking money and cashing out. In that sense, India is a success story for these investors, right? If you can take out 50, $60 billion in a year from an economy where you had invested a few years ago, I think it's, we all know that these kind of successful outcomes breed um, some sort of fresh grounds for fresh investments and fresh. We just need to find a spot when the markets and the global economy is in a slightly more calm and peaceful environment, right? Which is not the case today. Today we have tariff wars going on. Today we have geopolitical risks going on. So it's very, very hard for these capital decisions to be taken. As far as FPI flows are concerned, I think we all know that US exceptionalism has been having its in the past was having its sort of bearing on global equity allocations, right? And even despite being very expensive compared to the rest of the world, we still see US equities doing far, far better. So again, given what's happening to US equities, given what's happening to the fiscal impetus that is there in US, the fact that there's going to be rate cuts further by Fed, I still feel that the allocation towards the emerging economies for fixed income is not an easy thing. Uh, I think there is still a lot of hurdles for fixed income to see good allocation uh, in this cycle. Equities is a matter of question. I don't know where it goes.
So you pointed out net FDI, good point. And last week's conversation with Nilesh, his
Hmm.
point was in China is very restrictive on exits, for people who have invested into China. So from what you said, and I probably subscribed to the same that you know rather than being restrictive, it's better to be open, and it always will have far more dividends in the long term. You feel the same, or you would feel there
No,
should be
I,
some
I
risk?
think I think the good part is usually you would see that people will invest in an emerging market economy, and they will try and find the exit in a listing in a developed market, right? A bigger market, right? So let's say you do a Nasdaq listing or you do a LSE listing. Here you are seeing a situation where a global company has set up its subsidiary, right? And that subsidiary has been successful. And now instead of listing this subsidiary in your home market, you are listing it locally, and this market is giving you a better valuation than your home market would give, right? I mean,
That's a good
very
point.
few example you will find in the worlds of this nature. So it's not just about the fact that India can absorb a large amount of capital, help people, over a period of a decade or so, multiply that capital significantly. But also now our own capital markets are becoming deep enough for these entities to be listed and the investor to take its money out, right? I don't think even China comes close to this level of success, right? In terms of, so to me, these are obviously at a point in time we are seeing where net FDI is negative, uh, largely because there is a concentrated exits happening. But to me, as a market, this is a remarkable achievement, right? And I think this should breed a significant amount of investor confidence.
Absolutely. And as a corollary, current account has been relatively stable,
Yeah.
not an issue at all, and so also trade balance has been all right. So I think currency side always okay. Any forecast or any or gradual depreciation as usual?
No, I still feel that at the end of the day, it's about relative inflation differentials. If we're settling at about 4% and the developed world is settling at about 2 or less than 2, so about 2% differential versus major currencies is what will play out in our exchange rate as well. And that's, I think, where Reserve Bank will probably guide it through its intervention over a period of time. Obviously, there will be periods of, I mean, the more is the tolerance for volatility, there will be periods of, ups and downs around this. But in general, I do feel that 2% gradual depreciation in a year is the norm.
And you will have to live with those step movements
Yeah,
too.
you'll have to live with some wall around that path.
So then the final topic, final minus one, but the last one is different. So the second last topic, so to say, is on equities. You know, we can say that mimicked kind of currency behavior, FPI behavior, reactions to FPI, etc. So what's your comment? Do you think that's it, or is there more than that as far as our equity story is concerned?
See, to
Eighty-four
me,
thousand and go down and up again.
no, I'm not in the business of forecasting equities. That's a job that is done by our equities team. Look, my personal view around equities is that it's a very domestic story now for us, right? The amount of domestic savings which are getting allocated towards equities is steadily increasing. And to me, the fundamental story still remains that a 3,000 economy going towards a $15,000 per capita economy will see a massive amount of equity allocation to come through in times to come, right? So if you were to take a slightly longer term view, of course, short term, can be very noisy. But if you were to take a longer term view, I think the allocation of savings towards equities is only going to go up. And it is going to find its expression through mostly mutual fund industry, and for some of us through pension fund and NPS allocations, etc. Right. So effectively the same path. I do therefore feel that over a longer period of time, equity markets will continue to maintain its upside. But the supply will also be there, right? And this has been the story that as the demand has sort of picked up, you have seen a mismatch between demand and supply, but with a lag, the supply comes in. The promoters sell, the private equity firms sell. So all of this is supply that the market will have to contend with. So to me, I think it's a good good story so far of both demand and supply side for equities. I am long-term bullish on equities. I think Indian equities have to have a significantly major upside. And as developed market economies like US are becoming expensive, I mean, US is, for example, now 23 forward multiple, right? For a developed economy like US, for trading at 23 forward multiple, I would expect some mean reversion to happen at some point in time, right? And that's the time when you will see foreign capital flow towards emerging markets. And I do feel that in the current environment, India is probably the best story out there in terms of emerging markets, right? So again, I think in general we are broadly on the longer term perspective equity supportive, but we have our own ups and downs that we have to deal with, our own sort of short term hiccups that we'll have to deal with.
That's helpful. Lastly, now, in your role as FIMDA vice chairman, and FIMDA, obviously, we've seen it from the time it started. It has been involved quite heavily in trying to develop markets. Recently made an SRO, so on. More specifically, or very specifically on FIMDA, uh, I would like your comment on on corporate bonds, particularly. Market. The questions still remain what used to be 10 years ago or 20 years ago. How do you get liquidity in? How do you get depth into the market? You know, how do you? I don't know. Government bonds. RBI has done its best. We've got a great system going. Liquidity is great, etc. Though of course, on the run, off the run issues are still there. But more specifically for corporate bonds, any comments you have? Anything you guys are doing, or just two suggestions from your side? How do we get liquidity and depth in?
So Manoj, as a former director on FIMDA board, you know FIMDA as well as I do. Um, and you've been associated with FIMDA as well for a long period of time. I think it was our, if you recall, when we had set up FIMDA in 1990s, early
Yeah.
90s, right? Two aspirations we had. One was to have FIMDA as an SRO. Second was to have FIMDA have its own premises, physical premises, right? And I would say that uh,
Both are achieved.
this year has been very lucky year for FIMDA that both have been achieved.
When you were
Uh,
vice chairman, so great. I couldn't do it when I was.
no, no, I give it to Ravi, who's the CEO of FIMDA. I think he's taken a lot of initiative in this. Um, but obviously, I think part of the reason why FIMDA is where it is because it has had regulators' blessings. I think Reserve Bank has always given FIMDA a very strong importance in development of the market and treated FIMDA as a partner, as a instrument to develop the markets, right? And it is sort of reflected in the fact that every year when we hold FIMDA conferences, and that's the high point for us, we see governor's presence, right? Physical presence in our conferences. I think that's the biggest endorsement that any SRO could actually ever achieve or ever aspire for. So, in that sense, a lot of positive, I would say, uh, uh, encouragement by the regulator to act like one, to behave like one, and that puts a lot of onus on the organization to see what more we can do to develop the markets, which is what we do. I think besides the corporate bonds is obviously a different. I would actually divide it into two parts. One is to say that as a SRO now, FIMDA's role is going to be a lot more about market conduct issues, market behavior, some of those things, and also orderly development of the markets, right? As far as corporate bond markets are concerned, it's a holy grail that we have chased for the last 25 years, and maybe we'll chase for another 25 years. But I think what we have done over the last 25 years, we sometimes underestimate our own achievements. My view is that secondary market liquidity versus primary market capability are two different things. Even though our markets don't have the kind of secondary market liquidity that we would love to have, uh, primary markets have shown a remarkable sign of maturity. I don't know, Manoj, if you know this, but the largest single issuance that I have dealt with after coming to an Access was for HDFC Limited, and the deal size was 25,000 crores.
Oh, I didn't know about this.
Yeah. So if you think about this, this was just before HDFC's merger with HDFC Bank. Um, it was the largest single corporate bond issuance that we did, which we were part of. And it was amazing to see a 25,000 crore issuance getting absorbed in the market, picked up by the market, um, which is, by the way, bigger than the single issuance that Reserve Bank does for a government bond,
Yeah,
right?
absolutely.
I mean, collectively in an auction, they do 33,000 crores, but for a single issuance, they don't cross 10, 15,000 crores. It's 25,000 crores single bond, right? So sometimes we underestimate what our markets are able to deliver at this point in time. I have routinely seen now corporate bond issuers, quality issuers, access the market with an 8,000, 10,000 crore issuance, which is not trivial, by the way. Even for a
Right.
developed market, I think a $2 billion size issuance from an Asian, I mean, if you think about the global markets,
Yeah.
for an Asian issuer to do a $2 billion issuance is not trivial, right?
Oh, absolutely.
Likewise, in the domestic market, if a domestic issuer is able to do 8,000, 10,000 crores, it's
Very
reasonable
impressive.
size, it's very impressive. So I think the issue for us is the secondary market liquidity. And there we have some structural problems. I mean, if the largest insurer, for example, does not participate in the secondary market, then you know that
Yeah.
there isn't much that you can do about it. But I think markets, like I said, that duration and corporate bond risk is eventually something that will sit in the hands of pension funds and insurance companies. And as these players mature and as their AUMs grow, you will see corporate bond markets mature and grow. That's my core thesis. And I think we've seen that play out in some senses.
Which brings me to my last question, which I thought about just now, which is you mentioned HDFC's 25,000 crores. See, you've been, what, 5 years now at Axis?
6 years.
Six. And so, just a little bit of comment because Axis, I know, historically also and now, remains amongst the largest believers in corporate bonds in terms of trading, managing, underwriting, whatever. And, having spent a lot of time, Neeraj, you too, at a foreign bank, PD or whatever, and me too. I know how difficult it is to internally sell, this thing that let's go and trade corporate bonds, let's have limits, etc.
Yeah.
I'd like you to tell me about Axis Bank's philosophy, your philosophy, and what you managed to do here, ever since you've come, as far as corporate bonds or anything else you'd like to do.
So, when I joined the bank, obviously Axis was already the top number one arranger for corporate bonds, right? It had been for a very long period of time, about 12, 13 years. Today we are number one arranger for I think about 18 years at a go. Uh, so I have so my core thesis was that I want to retain the title that Axis already has, but I want to do it slightly differently. So what we were doing in the past was basically corporate bond investments were almost a parallel, wholesale bank, if you will, in the bank. So the key change that we brought in within Axis Bank was that we basically aligned our entire corporate bond limit setting, risk taking, and credit risk approvals along the lines of our lending approvals. So effectively, there is no arbitrage today between doing corporate bonds and lending in the bank. They all go through the same rigorous credit approval process. Also, we differentiated between syndication books or DCM books and trading books. So we have today a separate mandate for our traders and separate mandate for our DCM desk, and both of them are able to participate in the market with those different mandates, which basically internally diversified sort of pool of
Right.
this thing. And not only that, we today have also the mandate in our lending side to invest in corporate bonds with an objective of as a credit substitute, right, in case they want to. So effectively, we have three different strategies within the bank which participates in corporate bonds. But the bank remains very heavy believer of developing corporate bond market and participating in the market. And I think it's again reflected in the. I was just before I got into this thing, I was looking at our league table status for the first half of this calendar, and we still remain number one as far as the arranger,
Very
with about 15%
great.
market share. So I think that tradition continues, and that shows that the bank is fundamentally believing in developing this market.
Lovely. No, great. So that was it from my side, Neeraj. If you have anything more to say or, a message or something, welcome.
No, I think you talked about my background, as in I've spent some time in a foreign bank. Of course, I've spent roughly half of my career in a foreign financial institution. It was a bank. It was a securities company, Namura, um, and roughly half in the domestic, a little bit more than half in the domestic banking system. Uh, I am very strong believer of the ability of our domestic banks, right, to innovate, to deliver, and to operate at scale. And I think the domestic financial markets, like I said, we have a journey from $3,000 per capita to $15,000 per capita. And I think in this journey, the size and the scale of our financial system is going to undergo a massive change. And my message to some of your listeners, if they're just starting their career in this space, is that uh, the best is yet to come. We may have spent a large part of our career, um, getting the benefits of this transition, but the best is yet to come for them.
So lovely. I think great messaging, Neeraj, and I can clearly see the headline when Basis
Yeah,
Point tries to put this on,
yeah,
writing. But it was great talking to you, Neeraj. I really enjoyed it.
wonderful. Yeah,
Went longer than I thought it would, but
I know.
I had a lot of fun. I hope you did too.
I
Look
did.
forward
I did.
to the next time. Cheers.
Thank you.
Thank you.
Thanks for having me.